Why did Japan's shares retreat? And with the Fed statement release, where does this leave US bonds? Joining me to discuss is Daniel Baker from Informa Global Markets. Daniel, welcome. The 10-year US Treasury yield, which hit an 8-month high last week, caused Japan's bond yields to rise to their highest since November. Did this trigger a retreat in Japanese share prices? And will this rise continue?
I actually think the drop in share prices in the Nikkei in Japan was actually more linked probably with the FX movements and the yen trading against the dollar. Obviously, all these markets are interlinked, and the yields on government bonds are affecting FX markets as well. But I think that the Treasury yield was a byproduct of actually German yields rapidly rebounding, and that fed into global bond markets, and JGBs obviously rose at the same time. This is historically something that will weigh on stock market sentiment. There's no doubt about that. Higher yields, higher borrowing costs do equate to a detriment in sentiment for equities and less investment and people shifting into bonds from equities. So that does have a direct link. But I feel on this occasion that the decline in Japanese stock markets was more linked with yen strength.
US and Europe have indicated their economies are stronger than previously thought, seeing a surge in interest from Japanese investors. What does this mean for the future of Euro bonds?
Historically, in normal circumstances, rising inflation is coupled with and coincides with rising bond yields as well, based on the fact that economic activity is stronger, and central bank policy will be geared towards keeping a lid on prices and overheating in the economy. So I think that's perfectly to be expected and wouldn't be a surprise. However, I would say that the getting ahead of the inflation rise might be a little bit premature in terms of actual global price pressures, which seem very subdued, and really the recent rise in consumer prices in Europe and the US I think is more linked to a rebound in oil prices, which already looks to be topping out. So I think there will be a gentle upward sloping pressure in consumer prices and inflation across the globe during the course of this year, but it won't be anything too dramatic.
With the Fed statement release causing both bonds and the dollar to fall, what does this mean for US Treasury bonds for the rest of 2015?
Linked to what I just said about the outlook for global bond markets and in general, and yields in general, I think US Treasuries and the yield on US Treasuries will continue to creep up during the course of this year, the rest of this year and half two. But I don't think, again, it's going to be a steep gradient. I really feel that the Fed statement last night has underlined that any increase in policy rates at the short end is going to be really, really gradual. The Fed is not going to be complacent about tightening rates too quickly to choke off an economic recovery. Obviously, there are external factors, big external factors at play at the moment, including Greece and the potential for a breakup of the Eurozone and the fallout from that. So I think that the Fed and other global central banks are going to steer a very careful path.
Well, Daniel, thank you for speaking to us today. For the latest market updates, keep clicking back on the Dukascopy website. Goodbye for now.